Hello fellow human, nobody here with a new stock analysis. Today's question is, should you buy PayPal shares? As always, I will jump straight into my verdict and I will give you my reasons afterward. Let's go! At today's price of $59, PayPal stock is a buy. My price target for 2026 is between $75 and $165, for an average of $120 per share. This means I find the shares undervalued, with very limited downside risk and plenty of upside potential for the coming couple of years. The PayPal stock has been brutally beaten down in the past 3 years, losing 80% of its value from its peak of $310 per share. And you know what they say, when there's blood on the streets, you better take a good look at the growth and the valuation before you do anything else. And take a good look we will, but before that, a little disclaimer. If you're watching this, I assume you're not a lemming, but a sovereign individual. Nobody can tell you what to do with your own money. I only provide you the tools to take financial matters into your own hands. You alone are responsible for where you place your time and money and trust. So no, this is not financial advice. This is just how nobody invests. PayPal Holdings is a leading global digital payments company that facilitates online money transfers and serves as an electronic alternative to traditional paper methods like checks and money orders. It mainly operates in the payment processing, mobile payment, and peer-to-peer payment spaces, but it also offers financing and other transaction services. More recently, PayPal is expanding into the digital advertising space. The company launched its first product 25 years ago, disrupting the traditional payment methods by allowing users to send payments through email. The size and complexity of its operations have grown a lot since then, but at its core there's still a platform that allows both individuals and businesses to send and receive digital payments securely and efficiently. The company classifies its activities into two categories: transaction and other value-added services. In the transaction category, we find the revenue generated from payment transaction fees charged to consumers and merchants. And in the category of other value-added services, we find pretty much everything else that goes beyond basic transaction processing. In this second category, revenue comes from interest on loans, subscription fees for advanced payment processing and billing solutions, gateway fees, partner fees, and currency conversion fees. I will not go into more detail here about PayPal's products and services, but let me know in the comment section if you would like to have more information, and I will quickly put together a summary for you. Competition has intensified quite a bit in the last decade. PayPal has to face off against serious contenders such as Stripe, Square, Amazon, Apple, Google, Adyen, Visa, MasterCard, or Alipay, just to name a few. Looks like a tough neighborhood, doesn't it? Let's take a look at how the company has been doing. In the past 10 years, the average annual growth was 16% for revenue and 17.3% for earnings. As you can see, growth has been strong and steady, with a bit of a boost during COVID. And in the past couple of years, PayPal took advantage of the depressed share price to buy back shares, which is a positive for earnings per share in the long run. PayPal's very solid past growth sure makes the share price collapse from the last 3 years look a little bit strange. To be fair, 2021 was an everything bubble due to people pouring their helicopter money into the stock market and alternative investments. PayPal's peak of $310, for example, was detached from fundamentals, and so it will take a while before we see it again. However, right before COVID, the share price was $120, so it has lost 50% since then. Why the huge crash? And how long before it goes back up to those levels? Future growth expectations might give us some clues. For the coming 3 years, analysts expect an average annual growth of 8.1% for revenue and 8.8% for earnings. That's roughly half of PayPal's 10-year average. A very significant slowdown. So there you go, the growth rate goes down by 50%, so the stock must also fall by 50%. Just kidding. Growth slowing down so much is obviously a concern, but instead of the share price collapsing like this, it would have been more reasonable for the stock to just go up more slowly over time. Or would it? Maybe the stock had previously been very expensive and a correction was long overdue. That's not the case either. Both revenue and earnings multiples were very reasonable between 2015 and 2020. Let's see where they are now. As you can see, valuation multiples today are much lower than their historical averages. The PE ratio is half of what it used to be, and the enterprise value to sales has decreased even more. On the other hand, A PEG ratio of 1.8 is not particularly low, which reminds us that growth is key when judging valuation multiples. The EVS and P ratios are in inverse bubble territory. They are now doing the exact opposite of what they did in 2021. The stock was grossly overvalued then, and it is clearly undervalued now. Despite the slower growth, multiples should be higher for this kind of company. Also, I would not be surprised in the least if growth accelerates a bit in the future. I see no reason to doubt the management's capabilities, and I see the current growth estimates as conservative. The bottom line is that the stock should return at the very least 27% in the next 2 years, 13% per year. More likely, the share price should double by 2026. Do not despair if it takes longer. Luckily for investors, stocks that do not grow very fast can stay undervalued for a long time. If you found this video only mildly upsetting, please like it and subscribe to the channel for more. Share your thoughts in the comment section and let me know which stocks and concepts you would like me to explore in the future. If you have any questions, just ask. And until the next one, remember, if nobody invests, so should you.